Okay, everybody, now let's look at homework problem number 3, which is a 3-step problem. What we want to do in this problem is prepare the journal entry to record the sale of the bonds. That's part 1. And then we need to look at part 2 is going to be, and I'm going to actually just speak to this. Part 2 is going to be recording the adjusting entry for at December 31st. So I'll put the 2 up here actually. For recording interest expense. And part 3 is paying the interest expense on January 1st, 2021. Okay, so 3 parts to this question. Now, let's look at the initial facts. We're told, and I'll read from the problem. Wild Horse Corporation issued 4,100, 6%, 5-year bonds, 5-year $1,000 bonds, dated January 1, 2020 at 100. Interest is paid each January 1st. Prepare the journal, and then we're asked to do the journal entries, the 3 journal entries. Okay, so the first thing to note is that, again, we have the corporation going and selling to creditors, and these creditors are interested in purchasing, each certificate is going to, bond certificate will have $1,000 value stated on it, and there's also going to be a 6% interest stated on the bond. Now, we are told that that the bonds are sold at 100, which means this person's going to pay the actual $1,000 for this bond. Problems 1 and 2 looked at the idea of a discount and a premium. This problem is neither a discount nor a premium. It's actually selling for the face value, which makes it a little bit simpler. Okay, so this is what's happening. This person is getting the bond certificate. And they are getting the promise of interest revenue over the life of the bond, okay? In exchange, the corporation is getting access to cash. So that's kind of the exchange here between these 2 parties. This person's going to become a creditor to the corporation by virtue of paying cash. The $1,000 will eventually be paid back. So this person's going to purchase this bond for 2 reasons. Number 1, potentially 2 reasons, I should say. The idea of interest revenue over time, and maybe they want to sell the bond at some point for a profit, okay? What we're going to focus on in this problem is this first piece, okay, the interest revenue. The interest revenue helps explain why the interest rate is important and why a creditor will kind of enter into this arrangement with a corporation and help fund the corporation via debt. Okay. I'm going to erase this little diagram. I encourage you, though, to diagram out, draw pictures if it helps you kind of understand or kind of work out the logic of what's happening. So we want to, first of all, journal entry the initial issuance of the bond. Okay. Well, we want to look at this in aggregate. So we're told that we have 4,100 $1,000 bonds. So 4,100 times 1,000 gives us $4.1 million. Now let's look at the first journal entry, 1/1/20. We're going to sell the bonds. That means we're getting access to cash for $4,100,000, and we are setting up a bonds payable for $4,100,000. Access to cash through a liability. Okay, no discount or premium on this problem. So this is part 1. Part 2, the end of the year comes along, and at the end of every year we have to record all expenses that we incur. Well, this issuing debt requires us to recognize interest expense, which we're going to pay on January 1st. But December 31st is what our income statement is dated as of, so we need to record in our books this interest expense as of the 31st. Let me make sure I'm on the screen here. I am. Okay. Interest expense. And what's the number there? Interest expense of what? Okay, we have to go back to the $4,100,000 and $100,000, and we also need to look now at this interest expense. This rate, I should say the interest rate. The interest rate is always stated in annual terms. Okay, we are being asked to figure out an annual interest expense. So it's fairly straightforward. This can get more complicated if we have to figure out expense for like half a year. This problem is a little simpler. We have to figure out the annual interest expense. So all we do is we take the interest rate times the principal. So this is called the principal the value of all the bonds, the stated value of all the bonds, times the interest rate. Okay? And that will give us $246,000. Just do the math. Use your calculator. Make it easy on yourself. Don't do this. You got enough to write out with all these account names. Don't be doing long division, long multiplication. Just use your calculator. Okay, so $246,000. Let me move this little lamp. I didn't realize that was in the way. $246,000 of interest expense. Now, we are not yet paying it. We're only recognizing it at the end of the year. We're actually going to pay it the next day on January 1st. So for now, there's no cash being paid. So this is an interest payable. $246,000. All right, now we have to get to the actual payment. 1/1/21. We're actually going to reverse the payable. Now I am kind of going back to Principles 1 logic. We're reversing a payable and we are actually paying out the cash. And the amount will be for the payable we set up the previous day. In this problem, it's basically, it's fairly straightforward where, one day followed by the next. And this kind of emphasizes the importance of the dates. This is only one day, right? One calendar day might not seem a big deal. For accounting purposes, it is certainly a big deal. Okay, I want to point out one thing. This interest being paid out, okay, is income to the bondholder. And that's why that interest rate is so important, and why when a bondholder looks for a bond in the marketplace, they want to buy a bond that has a good rate of interest, because that's going to determine the amount of interest income that they receive. This can get more complicated, as we dive further into the discussion. For now, what I want you to know is how to do these basic journal entries in problems 1 through 3. Okay? Give it a shot. Keep in touch with questions. Rewind this video if you need to. Go back. If you can't read any of my handwriting, just let me know and I'll clarify. Good luck with it, and keep in touch. Thank you.